Every stock on every market in the entire world has a price. Have you ever wondered how that price is determined? When you walk into a bakery and ask the baker for a loaf of bread, you will only buy that bread if the price is equivalent to the value. If the price is $5, you might ask yourself, how much is the baker down the street selling the same bread for? What kind of bread is it? And perhaps even how hungry you are. It's no different when you purchase a stock. The only thing that changes is the questions you ask to find the true value that the stock has relative to the price. Perhaps one of the most complicated concepts in finance is company valuation. So today I want to walk you through company valuation to demonstrate to you that it's really not that hard. So what I'm not going to do today is start off with this scary formula. But it's helpful to know that the weighted average cost of capital underlines most company valuations, and we'll talk about it at a high level. Imagine that a company is like a pond, and this pond needs to be filled. And there are two streams that combine to fill the pond with water. In our analogy, this water represents capital, cash. The first stream represents investors who fill the pond with cash or water with equity. And the second stream represents creditors who fills the pond with debt. The combined cost for the company to get this capital is 18%. And that's just an example. And we're not concerned for this presentation how we determine the 18%. All you have to know is that it costs the company 18% to acquire the capital, which will eventually be used to get the return. As the seasons change, the water flows downstream. And now the company must pay back the streams. In this example, the equity investors get a 12% return and the debt investors get a 10% return. Except this isn't actually their return. The total return is only 4%. The 22% the company gives and the 18% that it costs the company to acquire the capital. So as you can see, it's important to understand WACC because the return is not 22%. It's actually only 4%. Once we understand WACC, it's fairly simple to get the company valuation. You take the projected company earnings for as many years as you want, and you divide it by the weighted average cost of capital. Then you get the discounted cash flows, which gives you the enterprise value. You divide the value of the company by the number of shares, and that's how you get a share price. If the price is more than the fair price, which we calculated, the stock is overvalued or it's expensive. If the stock is under the fair price, then the stock is undervalued, and it might be a good time to invest.